It's an awkward subject, no doubt, but ignoring it does not make it go away. Inheritance tax in Ireland can take a significant bite out of what your family receives after you're gone, or out of what you receive from a loved one. Today, I'll walk you through the numbers, the thresholds, and the ways to plan ahead in plain language. In Ireland, the tax that applies to gifts and inheritances is called Capital Acquisitions Tax, often shortened to CAT. The current rate in 2026 is 33%. That rate applies to the value of any gift or inheritance above your tax-free threshold. The threshold depends on your relationship to the person giving or leaving you the money or property. There are three groups, and the difference between them is enormous. Group A applies to children inheriting from a parent. This includes adopted children, stepchildren, and in certain cases, foster children. The tax-free threshold for Group A in 2026 is €400,000. So a son or daughter can inherit up to €400,000 from a parent over their lifetime without paying any inheritance tax. Group B applies to inheritances from siblings, nieces, nephews, grandchildren, and certain other relatives. The threshold here is just €40,000, far smaller than Group A, and it catches many families off guard. Group C covers everyone else: friends, cousins, unmarried partners, distant relatives. The threshold is only €20,000. So if your unmarried partner of 30 years leaves you their house, the inheritance is taxed at 33% on everything above €20,000. Let me show you what this means in practice. Imagine a parent leaves their only child a home worth €500,000. The Group A threshold is €400,000, so the taxable inheritance is €100,000. At 33%, the tax bill is €33,000. The child has to find that €33,000 within a set period or pay interest on it, even if they're not selling the house. Now imagine an aunt leaves her niece €100,000. The Group B threshold is €40,000, so the taxable amount is €60,000. At 33%, that's a tax bill of €19,800 on what feels like a generous gesture from a much-loved aunt. These thresholds are lifetime totals, not annual ones. So all the gifts and inheritances you've received from people in the same group, going back to the 5th of December 1991, are added up. If your parents gave you €50,000 for a house deposit 10 years ago and then leave you €400,000 when they die, you've used up your Group A threshold and you owe tax on the $50,000 excess. Now, there are exemptions and reliefs that can reduce the bill significantly. The first is the small gift exemption. You can receive up to €3,000 a year from any one person, completely tax-free, and it does not count against your lifetime threshold. So if both your parents give you $3,000 each per year, that's $6,000 a year every year, with no tax and no impact on your Group A threshold. Over 20 years, that's €120,000 transferred completely free of inheritance tax on top of the threshold. The second is the spouse exemption. All transfers between spouses and civil partners are completely exempt from capital acquisitions tax, regardless of the amount. This means a husband or wife can leave their entire estate to their surviving partner with no tax bill at all. The third is dwelling house exemption. If you inherit a house and you lived in it as your main home for 3 years before the inheritance, you do not own any other property, and you continue to live in it for 6 years after, the house is exempt from CAT entirely. This is a powerful relief for adult children who cared for an elderly parent in the family home. The fourth is agricultural relief and business relief. These can reduce the value of inherited farms or qualifying businesses by 90% for tax purposes, provided certain conditions are met. The rules are technical, but for farming families and small business owners, these reliefs are crucial. Let me give you some practical advice. First, plan early. Inheritance tax planning works best when started years or decades before it's needed. Once someone has died, your options are limited. The small gift exemption alone, used consistently over time, can transfer huge sums tax-free. Second, talk about it. Many Irish families never discuss inheritance until it's too late. Awkward as it is, an honest conversation about plans, expectations, and what's in the will saves enormous family stress later. Third, get a proper will drawn up. A solicitor will charge a few €100 and will save your family thousands in confusion, dispute, and unnecessary tax. Fourth, Think about life insurance. A specific type of life insurance policy called a Section 72 policy is designed to pay out exactly the amount of inheritance tax due on death, and the proceeds are not themselves subject to CAT. For families with a large estate, this can preserve the inheritance. Fifth, beware the rising property values. The €400,000 Group A threshold sounds generous, but in many parts of Ireland, the family home alone exceeds it. If you're a parent in Dublin with a house worth 600,000 or 700,000, your children will owe tax unless you plan ahead. And sixth, remember that the tax must be paid within a specific deadline, regardless of whether the inheritance is in cash or property. Many families have been forced to sell inherited homes simply to pay the tax bill. Planning prevents this. Inheritance tax in Ireland is not unfair, but it is unforgiving to those who do not plan. Thanks for watching. Comment below if you've navigated this yourself. Subscribe for more honest Irish money talk. Mind yourselves and have the difficult conversation.